Hello financial fans, welcome back to another stock analysis. Today we'll be looking at Williams Sonoma, stock ticker WSM. Williams Sonoma is a retailer in the kitchenware and furniture sector. Currently they have a market cap of $7.75 billion and the revenue in 2021 was $8.25 billion. Their dividend yield is currently sitting at 2.6%. Some of the brands that Williams Sonoma owns are Williams Sonoma Home, Mark & Graham, West Elm, Pottery Barn Kids, and Pottery Barn. Currently, their revenue is mostly generated through e-commerce. 66% of their revenue. 34% then is retail from stores they own. Looking at their brands, the brand that generates the most revenue for Williams Sonoma is Pottery Barn at 38%. Next to that is West Elm, 27%, Williams Sonoma 16%, Pottery Barn Kids and Teens with 14%, and others 5%. Calculate our final valuation of Williams Sonoma, we'll be using a margin of safety. This margin of safety is based on financial ratios and the financial health of Williams Sonoma. For this, we'll be using a scale. We'll be using in just a moment. This scale, when we're using 4 colors, adds 5% to our margin of safety when it's bright red, 0%, so no change, when it's orange. When it's light green, 5% will be deducted from our margin of safety, and when it's bright green, 10% deducted from our margin of safety. When we're using 3 colors in our scale, bright red will mean 10% added to our margin of safety, orange will once again mean no change, and bright green will mean a 5% deduction from our margin of safety. The first ratios that we'll be looking at are the EBIT growth and the margin growth. As we can see, the EBIT has been in a downwards pattern from 2016 to 2020, but in 2021 they've managed to double it. During this time, the average growth was just below 20%, which means the light green section of our scale means a 5% deduction from our margin of safety. The margin was also in a downwards pattern until 2021 when it actually went up again, was doubled. The average growth of the margin, therefore, is 11.28%, way outside of our scale, 5% deduction. The next ratios that we'll be looking at are the dividend growth and the payout ratio. As we can see, the dividend has gone up significantly over the years, going from 60 cents a share annually to $2.60 a share annually. The dividend growth during this period was just under 15%, which means in our bright green section of our scale, so a 10% deduction on our margin of safety. The payout ratio is sitting at 18%, specifically 18.5%, which means a 5% deduction in our margin of safety. The final two ratios that we're looking at are the debt to equity and the return on invested capital. As we can see, the shareholders' equity is currently larger than the liabilities, which on our debt to equity scale means a deduction in our margin of safety. To be specific, the debt to equity ratio is sitting at 0.77, so in our bright green section of our scale. The return on our invested capital for Williams Sonoma is sitting at just under 58 right now, which means way outside of our scale once again, so a 10% deduction on our margin of safety. Let's look at the valuation models next and determine the intrinsic value of Williams Sonoma. The first valuation model that we'll be using is the discounted cash flow model. As you can see, I've imported the free cash flow from Williams Sonoma from 2012 all the way to 2021. During this time, the average growth in cash flow was just over 30%. Because we're calculating the lifetime expected growth of Williams Sonoma, I've gone with a conservative 10% of the average, which is 3.12%. With this 3.12%, we can determine the future free cash flow of Williams Sonoma and determine the terminal valuation. This will be done with the perpetual growth rate of 3% and a discount rate of 9%. Combining all of the present value of future free cash flows, we get the sum of free cash flow, which is just over 18 billion. To get our equity value, we have to add the cash and subtract the total debt that Williams Sonoma is bearing. When doing this, we get an equity value of $17,756 million. To get our discounted cash flow price per share, we just have to take the equity value and divide it by the shares outstanding, which is 66.57 million shares. With the current price of $116.55, this is a whopping upside of $150.19, which is close to 130% upside. This is a massive upside, looking at the fact that we only got a lifetime expected growth of 3%. Let's go look at the next model. The second model that we'll be looking at is the dividend discount model. I've imported the dividend payout from 4 years ago, going to the current dividend payout. During this period, the average growth rate in dividends is 16.39%. I went with an expected growth rate in the future dividends of 30% of the average growth rate. This is just under 5%. From this calculation, we get a dividend discount model price per share of $91.34. The current price of Williams Sonoma is once again $116.55, so we get a downside of $25.21, which is just under 22% downside. The last model that we'll be looking at is the multiple valuation. By looking at peers that are related to Williams Sonoma, getting their stock price and their earnings per share, we'll be calculating their PE multiple. We'll then take the average PE multiple of the peers and multiplying it by the earnings per share that Williams Sonoma is generating. Out of this, we get a fair value of $154.61, with, again, the current price of $116.55. This is an upside of $38.06, which is just under 33% upside. Let's go look at the final overview of our intrinsic value. Let's go look at the final overview of our valuation of Williams Sonoma. Looking at our final overview, we have imported the discounted cash flow price per share, the discounted dividend price per share, and the multiple valuation price per share. The average of these three valuations is $170.89. Our margin of safety, we have determined our margin of safety before this. This comes in at minus 10%, meaning we'll like to pay more for the stock because of its financial health. Then we get a fair value of $187.98. With the current price of $116.55, this is an upside of 61.29%. If you do not like to use this way of calculating a margin of safety, we can just fill in 30% here, and then the upside only is 2.6%. I hope you enjoyed the video and learned something new. If you would like to see a company, please let me know in the comments. Thanks for watching.